So thank you everybody for joining us. So we're really excited about this panel. It will be on generating consistent yield in the unpredictable world of DeFi. So a brief summary about what we'll be talking about today is we've all heard about DeFi, but what exactly is it? And how does it generate this attractive yield? Simply stated, DeFi is a new asset class that allows investors to deploy capital into products receiving fees for work traditionally done by financial institutions. The yield is generated by DeFi investors are far beyond what traditional finance ever could. My panelists today are Kenny Estes, Bill Ditchler, and Sachin Jaitlin. Going to do a round robin and allow everyone to introduce themselves. So let's start with Kenny.
Hello, my name is Kenny Estes with Diffuse Digital. So Diffuse Digital, we create institutional grade investment funds for sophisticated investors to get exposure to digital asset investing strategies. We have 3 funds that are live. Actually, on September 1st, we'll have 3 funds that are live. One is an index fund. So think of it as it's S&P 500 for digital assets. So it's the top 30 market cap weighted index. The second one and the third one both are DeFi funds. So number 2, StableFi is the name of it. That whole strategy is we take stable coins, which are pegged to US dollars, and stake them into brand new cutting edge DeFi products and DeFi pools. So it's market neutral, meaning that the principal volatility should be effectively 0, but very high yield because of what we'll talk about here in quite some detail. The crazy yields that are out there in DeFi, if you know where to look. And then the third fund is called MaxFi, very similar to what StableFi is doing, where we're finding new pools, we're staking them with our capital. But the difference is we're staking them with the blue chip, for lack of a better term, cryptocurrencies. So Bitcoin, Ethereum, think. So it's you get the high yields, but you also keep that market long exposure. So if you're bullish crypto in the long run, probably a better fund, but very different risk profile.
Okay, Bill, how about you?
Hey, Jeremy, am I coming through at all on my?
Yes, sir. You are a little choppy, but I can hear you. Bill, you still there with us? Sachin, you want to go ahead and give your intro while Bill gets his straight?
Yeah, sure. No, thank you for that. And it's a pleasure to be here today. So a little bit on my personal background as well as what we're doing with the fund. So personally, half of my career was in finance, half of my career was in tech. The portion that was in finance, I was essentially going down the CFO track. The portion that was in tech, I was a former founder and operator of tech companies, squarely in the data and analytics space. And then in 2017, launched my first VC fund. Since then, we have merged into Morgan Creek, and we are now on our 3rd blockchain fund here at Morgan Creek. We've just launched the 3rd one. The first couple have done quite well. Probably most notably, we've helped support the likes of Coinbase and Figure and BlockFi and digital assets themselves, such as Bitcoin and Ethereum. We have hit the ground running with the 3rd one. We've completed the first close. We've started to deploy. We'll probably build a portfolio of about 30 companies and have successfully completed 5 of those 30 and probably have a line of sight to another 2 to 3 in the next month. So very excited about this space. And when we got in 2017, it's not many years ago in actual years, but in terms of this industry that we're in, and this industry being blockchain and crypto, and more notably here in a moment as we'll dive in DeFi, it's almost it's amazing to see what has transpired over the last few years and how quickly things are accelerating right now. So very happy to be here and answer questions.
All right, so just a quick note, if you have questions as an audience member, feel free to drop them and I will work them in as I can. Bill looks like he's going to be trying to call back in, so we'll go ahead and move things along and he'll join us back in, and I'll get him to do his bio and we'll jump back in. So first question for both you guys, what are the new strategies that you guys see emerging in digital assets beyond DeFi? Let's just start there. Kenny, you want to start?
Sure, I can take that one.
Right.
So yeah, DeFi is massive, right? Like there's so much opportunity out there. It's because really it's just taking anything that, like you said, Jeremy, at the beginning, a traditional financial institution does, and just doing it in a way where you're not paying for all the bureaucracy and executive compensation. That's financial institutions do a lot of things. Right now, probably the most certainly lucrative and most popular is akin to what used to be market making. So taking, I actually was a market maker for about 10 years as a high frequency trader, but taking what I used to do with bids and offers and doing it in a decentralized manner. So that's pretty exciting. But the future of what that looks like is really fascinating. There's, investment banking as a general rule, like marketplaces having the secondary transactions for securities and doing it in a more streamlined manner on a blockchain. It starts taking, eating the lunch of traditional transfer agents, some custodians. You can come up with better ways to do that without having a custodian. So there's really a lot there. And then just more generally, you're seeing really fascinating applications of these types of concepts. Play to earn has really exploded lately. If anybody wants to go check it out, go check out Axie Infinity. It's, I think, the largest, fastest growing game ever. And it's really giving people the opportunity to play this game and earn actual money, like replacing salaries in many cases. And they just do this on a full-time basis. And you're just now starting to see, or we're hoping that we're going to see that continue to go towards more generally a way of re-envisioning what looks like entirely. And now you can really tap into the global workforce.
I'm going to let Bill do his intro real quick, and then Sachin will come back to you, okay? Bill, do you want to do your intro? You're muted right now, so you have to hit unmute.
All right. Coming through.
Yes, sir. We can hear you nice and clear.
Yeah, I apologize. I'm out here on Long Island, and the internet's a little funky, but pretty good. So yeah, thanks so much, Jeremy. Really appreciate the opportunity to be on the panel. My name is Bill Deichler. I'm Chief Investment Officer of a single family office based in Central Florida. And we've been looking at the blockchain digital asset space for a while. Previously, I was at Morgan Creek and was heavily involved in the Morgan Creek Blockchain Opportunities Fund, Funds 1 and 2. So I have a good background in the digital space. And currently we are beginning to look more heavily into the DeFi space. So I'm very pleased to have this opportunity with my esteemed panelists.
Okay, so Bill, what we were covering and Sachin is about to answer was what were the new strategies that we see emerging in the digital assets beyond DeFi. So Sachin, I'm going to hand it back over to you, and then we'll keep going around.
Yeah, sure. It's a great question, and I think as Kenny was alluding to, we're still in a very nascent phase in terms of what DeFi can promise and build out. And I think he highlighted some really good use cases where we're going to be able to see a lot of application and what's DeFi is to come. But even beyond that, some things that I'm looking out beyond on the horizon are probably in the world of what I'll call NFTs and what I'm going to call blockchain intelligence. So just squarely in NFTs, I mean, right now we're talking about a evolution around digital media. We're talking about music. We're talking about, Beeple paintings. But there is a whole nother next chapter around this, and it's going to be authenticating the day-to-day documents that we use, such as your birth certificate, your wedding certificate, the title of your home, the title of your car, your diplomas. All of that will be put on NFTs in the future. And so document management is going to be transformed by NFTs. I'm already starting to see corporations starting to manage some of their executed documents and placing them on chain by NFTs for document management purposes, for transparency and authentication. And so that's happening right now. And so the earliest stages of it starting to occur. And so I'm really excited about the direction that's going. So keep an eye out in terms of where NFTs will fit into your everyday life. And the second piece I'll touch on is blockchain intelligence. And this is something that we're kind of anchoring our latest fund around. And it's the combination of blockchain plus artificial intelligence. And so let's just unpack that for a moment. Blockchain is, you strip away the hype, you strip away all the headlines. What it's really good at is it's an accounting system. right? I think most of the people on this webinar will probably recognize that. It's really good at accurately accounting for things. And it's not just numbers, it could be anything in a spreadsheet, medical information, personal information, but it stops short of doing something with that data, right? After it structures it. And that's when the baton is handed over to AI. AI does a really good job of making decisions from data and making predictions. And those predictions could be around risk assessment or fraud detection or consumer behavior. And these two technologies complement one another very well. Blockchain is a great way to structure data. AI is a great way to make decisions from data. And so one of the next chapters that we're betting on is that there's going to be a unified tech stack that is going to be called blockchain intelligence. And so we're looking at projects aggressively right now that encompass both of these technologies together. And so we're very excited about that as well. So hopefully that helps.
That's great. I mean, I hadn't even thought about blockchain intelligence, and I had recently just heard about this play to earn with like Axie, Kenny. So it's a fascinating place. Bill, what do you think about, you know, this kind of tsunami of info that's coming our way? What do you think about it as a traditional investor?
Yeah, no, very, very well put. You know, the way that I think about it is that the whole digital asset space is creating a parallel universe to the existing financial system. And it's something that to some degree is happening in the background because not everyone is cognizant of what's going on, but it is a tremendously vital space that has an unbelievable amount of activity. And you can, I don't know, the way that I think about it is that the existing financial system is being slowly mapped into this new universe, sort of piece by piece. And as the technology advances, there's competency and security around these individual pieces that we haven't seen before. So it is a tremendous opportunity to disintermediate many rent-seeking third parties. I think there is also a tremendous opportunity inside of business automation, in the sense that we will be able to streamline business processes in ways that are almost unimaginable. So the opportunity set is huge. With regard to DeFi specifically, I'm thinking about that in terms of the next frontier of fixed income type assets, because as we all know, with bond rates continuing to be at rock bottom levels, traditional fixed income has a difficult hurdle to surmount to be able to generate returns for large institutional portfolios. So given that, and given the fact that it's occupying anywhere between 20 to 40% of a portfolio, these your strategic target, you've got a pretty big hill to climb. So what do you do to kind of fill that gap? And I see DeFi as potentially being one element of a strategy that can really help plug that hole.
So I'm gonna cut to the chase. I think what Bill and I and everybody else on this webcast want to know is, Kenny and Sachin, how do you find new projects? I mean, can you guys give us some tips or some insights into your thoughts on how do you discover these new technologies and these new exchanges and new dexes and everything? Kenny, you can start.
All right. So yes, Sachin and I have a slightly different strategy. So with us, we're looking for brand new pools. In any given day, there's usually 4 or 5 that are launched. I think the oldest pool we're currently invested in is about a month old. So these things, it is an incredible amount of turnover, and the yield's really high on day one, and then it just goes down, and then you roll out and go into the next new pool. So finding these, there's no good way to do it. We hire somebody that's his entire job is find new pools, and that involves going to Telegram and Twitter and seeing what projects are being mentioned and where things are, and just cross-referencing and checking. And there's no database you can go to, so it's just hours. Like that is unfortunately about the only way to go about it.
Well, that's where the opportunity is created. Exactly. Sachin, what about you? How are you finding these new projects? What's your process?
So the process to identify, to find any projects would be probably a little bit different to kind of vet the new projects. But you know, the deal flow for us, we are in a fortunate position that we've launched our fund a few years ago, and we feel pretty good about the amount of attraction that we've been able to get in the space and kind of become a fixture. I think we're probably top 5, top 6 AUM in terms of the largest funds that focus on blockchain. And so we do have a good amount of deal flow that's inbounded to us. We also have a network of entrepreneurs, a network of VCs that like to socialize deals with us. And so we have a good stream that's coming in. I think probably more to your practical question about, you know, what's exciting us? How do we vet these things? And for me personally, I'm a product person first. I actually consider myself more of a product person than even an investor at times, right? I like to dig in and understand what's the practicality, what is the adoption likelihood of this product going to be? And that's the hardest question to answer. You know, you could love the technology, you could love the use case of it, but the hardest thing to predict is the adoption of it, because you could be too early, you could be too late, there could be too much competition, you could be just in that sweet spot, in that Goldilocks zone and get it right. And so I step in the shoes of, from a user perspective, from a client perspective, and I really like to, you know, get to be sure to understand that this is an experience that I'm gonna value. And people on the street, the general public doesn't care if it's cloud or if it's blockchain or if it's AI. Those mean nothing to them. But what they should feel through blockchain is really 2 values that are passed down. And those 2 values should be, things should be faster and less expensive. At least in my opinion, those are the value prop that we pass down to the general public. In the experience of using this company's services, are we getting those things? Are we getting things faster and less expensive? And if so, you know, where's the competitive moat? And then we can go into all the other normal standard VC questions. But I start off a product and I really dive into that side of it first.
So I'm going to ask an audience question. I'd like Kenny and Sachin to give me your answer. And then Bill, I would like to hear your feedback on their answer, okay? So the question is, can you discuss the largest risk you've seen in staking, lending, and using pools for yield? What do you guys think about that? And then Bill, I want you to kind of give me your feedback from a traditional investor's perspective on their answer. So whoever wants to go first.
Jeremy, I love that approach. We're gonna answer, and then Bill's gonna judge us. Brilliant.
Yes, let's do it. Let's do it.
I hope we get an A. Yay.
Let's do it.
All right. So there's all sorts of pools, right? Or all sorts of issues. And this is the Wild West DeFi. I don't know how else to describe it. The infrastructure is, let's just say, shaky and not well developed and still being done. And most new pools are literally Control C, Control V of an existing pool. The first thing is test everything, right? If you're going to go in there, test. Put money in, take money out, make sure it worked. I mean, it sounds silly, but if you don't do that and you don't do these test transactions, that's how you end up with $600 million disappearing from Poly Network over their bridge transactions, right? Simple things like that help solve the problem. Now, specific to DeFi pools, when you're looking at a pool, which I think is part of what what the question here is, there's really 3 main risks for a particular pool, right? The first one is each pool, they create their own new cryptocurrency that they pay the rewards in. So that if the developer, they get some of these tokens, if they choose to, they can just sell all of their tokens and abandon the project. Now, in that very simple scenario, that's called a soft rug pull, because apparently everybody in crypto likes to reinvent terminology. And so when there's a soft rug pull, you can still get your principal back, the amount that you invested, but you're going to lose the rewards because the value of the reward tokens that you're being issued goes to 0 very quickly when a soft rug pull happens. There's not much you can do about that, frankly, right? Because the developers can just unilaterally decide to do it. There are ways for developer tokens to be locked up. So make sure that there's a lockbox in place, things like that. Be reasonable about it, but also make sure you diversify. The second class is called a hard rug pull. This one does require the developer to be a little bit malicious and try to put a backdoor in the code so that not only can they sell the reward tokens they've received, but they can also get the principal. And now that is a big no-no, and it's scary, and we've not gotten hit with it yet. I think it's a matter of when, not if, though. You can help avoid that by looking at audits. Be very wary of any project that doesn't have an audit. And there's a very good service called RugDoc that new platforms come on, and they look for the most common backdoors that people use to do these hard rug pulls. The third risk is that I kind of have on my list here. It's almost another variant of the hard rug pull where there's a hack. Most cases, the hacks these days there is a backdoor that nobody knew about, so it wasn't malicious, but somebody found a way to get in there and actually get at the principal and steal it from the pool. That's becoming more and more rare as people understand. And like I said, it's all copy and pasted, so you just kind of look for the same code and you're generally safe. But all of this is be very wary. Do your research, do your test transactions, look at the audits. Don't just go, oh, look at this brand new pool that's got 3,000% APR. I'm going to go make money really quick and then just get out. That might come back and bite you.
Sachin, what's your take?
Yeah, I think it's actually very interesting to hear some of Kenny's thoughts, because we operate in two different dimensions of the kind of like the same ecosystem, and it's really cool to kind of hear how he's approaching it. So some of the risk that we see. So the base, I would kind of formulate a couple things. So one, there are layers to these protocols, right? As perhaps some of us are aware of. There's a base layer, and there's kind of some application layers that can stem up layer 2, layer 3, beyond. The base layer, let's use an example of Ethereum. Ethereum is a base layer protocol, right, where applications are, DeFi applications are built upon. In my opinion, there is very little risk today around that base layer protocol. It's been proven to be very secure. It's not to say that there's no risk, but there is mitigated risk on that base layer. Your real risk layers occur on the application layers that are built on top of these protocols, right? Layer 2, layer 3, layer 4. And so what I would describe as on ramps and off ramps of those base protocols is where the risk points are, right? Where you should be cautious about, and you should do your diligence on. And there's going to be a couple of communities that you're going to want to make sure that are there and are operating correctly. There's a community that are going to be validating transactions, and there's going to be a community that are exercising transactions, right? Those are going to be the two communities. And you need, for any blockchain and any protocol to operate efficiently, you need both of those communities to be there and robust in size and quality and frequency. So, check out, how the node strategy, the node structure, the node community on the validation side, check out what population, what frequency, how many, the quantity is on the other side. And that's how you can kind of better vet some of these things. The other thing I'll say is definitely as of late, there's been a heightened interest around regulation. And there's been, and I want to be clear about something. I don't believe that regulators want to ban cryptocurrency, want to ban blockchain. That is not from all indication that I see, that is not the intention. The intention is to clarify things around cryptocurrency, around DeFi, around blockchain. And they're going to get it right and they're going to get it wrong, right? That's just the nature of this game. And some of the points of clarification are going to be around ownership, around possession, around liability, around broker, right? As we saw in the infrastructure bill, right? So these terms are being defined in real time, and we're kind of witnessing history right now, right? We have a chance to participate in this legislation and as a community and help guide these regulators to be as accurate as possible with their intention, right? To protect consumers, and we all want that. But there's going to be overstepping and there's going to be understepping. That's just is the ebb and flow of legislation. So, just be aware that some of that is being fleshed out right now and will have implications, right? But once again, we saw in the case of the infrastructure bill, the definition of broker could have a real impact on DeFi and how staking nodes operate and what kind of overhead that they would have to take on. So That would be the other risk point here.
Yeah, I saw over the weekend how a lot of the DeFi, I guess DeFi Twitter was organizing to try to have some influence on the bill. It was definitely a show of a decentralized community, like in process. So, Bill, what do you think about these answers?
Do not poke your I was just saying, do not poke your finger in the crypto eye.
Right,
It will.
it's coming
It'll
for
react.
you.
Yeah.
Bill, what do you think about all this?
Yeah, just as a side note to Sasha, I was just at lunch, about an hour ago, and we were talking about the lobbying effort that was surrounding this bill, and there has been a significant amount of effort and money, put into it to try to channel it in the right direction. And I would also echo those comments that the regulators really do want to try to understand it. I don't think they're trying to squash the entrepreneurial nature of it, but indeed, to clarify the playing field. And I think that goes to some of the comments that the guys have made, and it speaks to really operational and counterparty risk, which traditional investors, it's gotten to the point now where almost you can take that for granted. But I think in the digital asset space, it's something that you have to pay attention to, and pay attention in a way that you never have before, because in many cases you're not talking necessarily about people, but you're talking about code, because code is running the operations. Code is actually dictating the strategy. So and that opens up like a huge question mark. And to some degree, I think that larger institutions and perhaps less sophisticated ones will have difficulty getting over that hurdle. But one of the key remedies for that is domain expertise, and many of the investors can get only so far. So in particular, Sasha and Kenny, maybe you guys can talk a little bit about the degree of domain expertise that you feel is necessary, on your part, and then also on the part of investors, to be able to really evaluate these strategies in a way that will give them sufficient comfort.
Kenny, you want to go first?
Sure, I can go first. Domain expertise. And actually, I'm going to plug this in with Peter Walk's question in the chat, because they're kind of related. It depends on really what you want to do and how much yield you want. So there's established platforms, Uniswap, SushiSwap, to name a couple, that they've been around for, something that's been marked in years, right? And you can do some small amount of staking on exchange, but in most cases, you're going to need to get a wallet. You're going to need to get your hands dirty. So that is domain expertise, right? Actually getting out there, doing the work. Get a wallet, get MetaMask. Like, there's guides out there that can help you through this process, figure out how you get your money in there. All of that is a learning process, and that will most likely take you a couple of weeks the first time you do it to get all of the pieces in place to actually do this trading. It's a little bit more involved than if you are doing it on a more centralized exchange. Now, for us, domain expertise is kind of really, really a big deal. And there's not a lot of more established platforms, because it is, our stuff has been around for days, not years. So it's very, very different in understanding, okay, to Sachin's point, like, okay, is this a level 1, level 2? Where are the gas fees? What are the differentiations? Even understanding the difference between Polygon and Binance Smart Chain and Cardano and Solana and Polkadot, all of these are different flavors and have very different value props, but all of them, at least in theory, are going to have DeFi elements to them. So understanding the difference between these exchanges and how they're not Ethereum, and why there's so many issues with Ethereum and the way that it operates. Once you get kind of about that fringe, it's all about domain expertise and just continually researching and learning.
Sachin?
Yeah, I'd say I'd probably compare CeFi and DeFi for a moment, and saying, if you're looking, depending on your level of domain expertise, you would probably want to consider these things of CeFi versus DeFi, and how comfortable you are in operating your own or engaging the decentralized world, and whether it be from a DEX perspective, a decentralized exchange, or or something else. Now, I view, so just to kind of put this in perspective, like something like a Coinbase, I would consider more of a CeFi tool. Something like a decentralized exchange, that would be a DeFi tool, right? And I think the on-ramp for most folks who do not have, or just trying to get into the space and trying to engage blockchain, cryptocurrency, whatever, trying to gain some of the benefits even through DeFi tools and DeFi use cases, can engage CeFi, and feel free to continue doing that. I think if you are a little bit more comfortable in this world, and because some of these tools, these DeFi tools that are emerging, their experiences are still being developed. Their use cases are still being developed. So they're not fully fleshed out yet, right? We're building this whole space in real time right now. So I'd say anybody can join true, pure DeFi. But if you don't feel comfortable doing that, it's okay. You know, you can start off on from a CeFi perspective and then merge into a DeFi world. Now, I think also an easy use case to kind of get into the DeFi world are things like stable coins, right? I'd say stable coins, there's been a stampede of interest activity in a stable coin. And forgive me if any of this is obvious or redundant, but just taking it back to the basics for a moment, a stable coin is a non-volatile coin, in contrast to a Bitcoin that moves up and down. A stable coin is pegged to the US dollar, and you own a stable coin and you're paid out in a healthy amount of interest. All right. What is happening on the back end of a stable coin, kind of the business model of that, is that those companies that own stablecoin are doing a few things. They're either lending it to somebody, they're investing it in low risk bonds, or in some cases maybe even higher risk bonds, but I think most cases low risk bonds, or they're just putting it in cash and earning cash interest, right? So there's something happening on the back end that's generating revenue for them. They're paying you out interest and walking away with a margin, right? And that's it's a great way to kind of enter the DeFi world, if you like. But there's many ways you can do it. I'm just giving you one of many examples. And probably the largest stablecoin, just so everyone is aware, is the USDC under Circle, 25 billion under management, expected to go public this year via SPAC. And so a huge success story of what that product offering has.
So let's go back to it.
We'll just jump in real quick. Sachin is far too humble. Probably our favorite on-ramp is one of his portfolio companies, which is BlockFi. BlockFi is DeFi under the hood, but you can get in there. You don't have to overthink it. You don't need a wallet. You can use it to put money into a wallet if you want to go further down the rabbit hole. But even if you just use BlockFi and its core product, you're going to get 10 times the return that you would having that money set in your bank account.
Great.
100%. Yeah. Thank you for saying that, Kenny.
Let's go back to a topic we were talking about a few minutes ago, which was regulation. So a debate we have in the office often is DeFi even, like, can they actually regulate it? Because like Bill said, it's code and it is decentralized. And so Kenny and Sachin, if you guys were regulators, how would you actually regulate it? Because I haven't gotten a good answer on how it actually can be regulated. Either one of y'all want to go first?
So yeah, I'm happy to kind of take a stab at this, and let's take a look at what has transpired in regulation so far. So the New York State, I'm going to make comments about probably 3 or 4 jurisdictions: New York State, Wyoming, Florida, and federal government. All right, New York State has in 2015 they came to with two laws: the BIT license and the, I always say this wrong, but New York Limited Purpose Trust. That's what it's called, New York Limited Purpose Trust. So these 2 licenses came to be, I believe, around 2015, right around that time. Effectively, what they were providing clarity on many things, but one of the things that they were providing clarity on was very analogous to a money transmitter license in a traditional financial world. And what a money transmitter license is, if you move money from point A to point B, do you just route it, or are you taking possession of the funds in between that route? If A go to you, then go to B, right? If you take possession of those funds in a conventional financial world, you are considered a money transmitter. And if anybody on this call has ever tried to get a money transmitter license, I have, And it is difficult. It's very hard. A lot of overhead, a lot of auditing, a lot of compliance that you have to go through in order to become a money transmitter. A very expensive process. So New York State deemed, if you are an exchange, if you're a custodian, if you're touching cryptocurrency, you are acting in some of the same regards. I'm using this is not a one-for-one exact ratio, but it is very analogous to a money transmitter. And you will be considered a money transmitter, you're gonna have to go through all of this overhead. So it's such a hard thing to achieve, and it's such a hard thing to maintain, that there was an exodus of crypto companies, blockchain companies that left New York because of this. They still haven't come back. They still don't do business in New York because of these laws. There's a handful of companies that said, you know, love it or hate it, we're going to engage these laws and we're going to operate under this guidance. So they clarified, though, this thing is around regulation. They clarified that if you're in possession of these funds, essentially, you are liable for them. So as an exchange, if you're transacting on somebody else's money, you are liable for that, right? So that was a clarification that was made that shouldn't be thought of as obvious or anything. And I'll give you another obvious kind of, or somewhat obvious. In Wyoming, we have Avanti Bank, right? So the founder of Avanti Bank, a great attorney who Caitlin Long, I believe is her name, who has worked with a lot of the legislators to enact some laws and guide them on some of the laws. One of the things she did really uniquely in Wyoming is, if you deposit money into a crypto company, actually, let's take a contract. If you would deposit traditional fiat currency in a bank, you are essentially given back an IOU. You've given ownership to the bank. The bank can do whatever they want with your money now, or within bounds, right? They can lend it, they can create products, and they can offer services, but they have an IOU. It's no longer your money. It's not your property anymore. In the world of Wyoming's cryptocurrency law, Wyoming said, you know what, it is still your property. It is your ownership. And so she helped guide that legislation, right? Talking about clarification here, it is still your property. Even though it's deposited somewhere else, and even though they can do something else with that money. Florida, and particularly in Miami, they've started to mirror some of those Wyoming laws, right? And you know, obviously the mayor of Miami has done a really good job of making a lot, being a big advocate for our space. So they've started to embrace and engage some of the laws from that Wyoming has set up. And then on the federal government, a clarification that we've just discussed is broker, right? The definition of a broker and how the wide-ranging implications of that from the federal government. So I want to share all that context with everybody, because there is real-time discussion being had by different jurisdictions. And this is I just gave you 4 examples, but it's happening all over the world. The whole world is trying to figure out and clarify so people can be protected. And if there are litigations, that litigations will have the correct laws that judges can operate within. And so all of this is happening in real time. There are certain things that are being decided upon and defined. And I think some of the things I just mentioned around possession, around ownership, around broker, there are some of those aspects are going to be leveraged all around the world, right? So that's how I view it. So I hope that paints a little bit color for everybody.
Kenny, what do you think? I mean, can DeFi actually be regulated?
I think I need to take faster notes because I didn't know any of that. That was brilliant, Sachin, especially with all the state regulation. One thing that I think you started going towards there with the broker definition comment was the infrastructure bill, which recently came through, which just cleared the Senate yesterday, day before. I don't know. I'm losing track of time. And but there they basically put language in there that was very broad, so that pretty much all crypto players now qualify as a broker. Now, what that means in reality is it creates incredible AML, anti-money laundering, and KYC, know your customer requirements for everybody who would be a broker, as well as they would have to, in some cases, register with the SEC and FINRA and the state as a broker dealer. So that's just a lot of process and that they need to go through to just run their day-to-day business the way they have been for the last, 5-10 years, whatever. If you're a minor, 10 years, right? The net effect of that is, I think, unless that gets defanged in the House, or when they're actually doing the rule implementation, you're going to see a flight from America. And we actually had fellow by the name of Richard Titus on a webinar yesterday, and he the way he put it was the U.S. is at a severe risk of becoming a digital backwater, which was really, really fascinating. So, but to your other point, Jeremy, how to more positively, how to regulate it?
Right.
It's tough, right? Because a lot of these things are securities. The SEC has a very famous test called the Howey test that has very clear criteria that when something qualifies as a security, if and when it's issued in the U.S. I don't think you can really argue justifiably a lot of these DeFi things aren't securities,
Right.
which means that they need to act like securities, which means if you're going to raise securities and you're not doing AML KYC, you've got some real issues. And there's all sorts of accreditation checks depending on what exemption you want to do. That's a whole can of worms. So if they're taking that position, then you also can't have DEXs in this current form either. So the DEX is a decentralized exchange. If you're a security, you need to do actual transactions on a registered marketplace. So there's really two flavors of that. One's called an ATS, alternative trading system. It's kind of like a, I don't know, kid version of a full-blown exchange. And then the other is a full-blown exchange. So that's a whole thing. if these are securities and not like, okay, well, how in the world are you going to do that? Because that's a very difficult license to hold. We're investors in a company that did get one of those ATS licenses, which is great. But they're very, very few and far between. And it's certainly not like to the point of having these pools come online all the time. So maybe we can go that route. There might need to be put some exemptions around it. So like securities that are crypto, you need to have a lightening of the registration requirements. But if you're going to do it the right way, and I honestly do think that the right way to do this is to fully regulate these. And the reason is because there is so many people coming in that are just seeing the returns, they're seeing the opportunity, and they're throwing money out and they're getting burned like bad, right? And the market goes up, the market also goes down. So the whole point of regulation is to protect the end investor. I think this industry doesn't need that. But to my earlier point, if we do that properly, one of two things happen. To Sachin's point, the rest of the world takes our blueprint and applies it to their own country. That would be great. That also seems unlikely. What's much more likely is every other country is going to be much more lenient because they realize how much revenue this industry is generating.
So that brings a question: if everything or a lot of the innovation goes outside of the US, Bill, as an investor, would you only invest in domestic companies, or would you be willing to invest in companies that aren't in the US as well?
Yeah, I think it brings to mind, it's not really just a question of geography, but it's a question of accountability and, if you will, sort of veracity. So if countries are fleeing, or if companies are fleeing the US because they want to get to a less restrictive environment, what does that really say about the companies? Is it truly a business decision in the sense that, you know, we have a legitimate strategy here, but we just can't operate under US regulations, and so we're going to go someplace that does facilitate that? Or does it go further out the spectrum in the sense that we don't want to be operating under US regulations of that type, and we would prefer to do it because it gives us more latitude to do what he did? This is a hard thing to articulate, but I think you have to look at the nuance of what's the motivation if it comes to this. I hope it doesn't. I've actually had the opportunity to talk with a couple of SEC officials, and I think they're genuinely interested in creating a constructive environment. But much as what Kenny was saying, and I think Sachin was alluding to as well, we really need to clarify things, and we need to make sure that we have a fair and level playing field. And above all, the SEC mandate is to protect the retail investor. And because the whole digital space is a very unique phenomenon of having actually grown up in the retail space rather than the institutional space, you're faced with a very unique type of regulatory challenge where all of a sudden you have a lot of people out there who don't have a ton of sophistication are getting into this, and they are getting burned. You know, I mean, let's just call it the way that it is. So again, you know, I think that more regulation is better. Smarter regulation is even better than more, and I hope that we'll continue to, you know, to go down that line of thinking.
Okay. So Kenny and Sachin, what are some lose my shirt mistakes, or just what are some mistakes investors should try to avoid? Sachin, how about we start with you?
Well, here's okay. Lose my shirt. It's a good question. So there are lots of cryptocurrencies out there. There's lots of services that are popping up, and you know, this is actually a good statistic for everybody. This is it just gives a proxy of how big things are kind of expanding. Any one of us could probably rattle off a dozen or so exchanges. In reality, there's closer to 300 to 400 exchanges today. Okay, the number is much bigger than I think most people actually understand it to be, and that number is ballooning. I expect over the next few years for there to be over 1,000 exchanges.
Wow.
And then the subsequent 5 years, let's call it between 2025 2030, I expect a massive consolidation, all right, occur. So you're going to see this kind of diamond structure of a boom and expansion and a consolidation. And but I think what we're feeling right now, this will probably be the steady state of around 300 to 400 exchanges that will exist in the world. And you'll be differentiated on region, you'll be differentiated on service, or, you know, white glove versus retail, value versus non. And so, but I want to share that context with you because there's going to be an explosion of different cryptocurrencies as well that are out there. What I invest in terms of cryptocurrencies or platforms are based on a use case, right? Kind of going back to what I said earlier, putting a product hat on. Not all cryptocurrencies are equal. Bitcoin is very different from Ethereum, right? And Ethereum is very different from, you know, you name it. These are different use cases that are going to exist in the world, and it actually goes back to the invention of the internet. When the invention of the internet came to be, there was hundreds of protocols that came out. Today we have 4 to 5 protocols, right, that we all use, right? We have HTTP. There's just a handful of these, right, that are left and remaining. The same thing is going to happen, I believe, in the world of cryptocurrency. There's going to be, you know, hundreds and hundreds of these, but ultimately the ones that are really going to survive, the ones that are really going to create value, are based on their differentiated use case. And I'd say, going back to the lose my shirt kind of question, don't invest in hype, don't invest. And frankly, I have friends who do invest in that way, and there's arbitrage to be made, but it's a high risk game, right? Mm-hmm. If you're okay with high risk play, go for it if that's your thing. What I would advise most people to do is invest for the long haul, right? Invest in a proper use case. Bitcoin is a wonderful store of value. If you're looking for a store of value, do that, right? Ethereum is a wonderful developer network, right? A developer platform, right? So you can build smart contracts off of. There's a whole host of other altcoins that I'm very excited about, very interested in, that have their own unique use cases, right? And so that's how I would view the world. Don't just base it off of what somebody's tweeting. Don't base it off of a headline. You will frankly not only lose your shirt, but you'll be, yeah, through that, the volatility, you're gonna lose your lunch as well. So just hang tight, focus on the use case, focus on the long haul. There's so much money to be made, so much value to be created over the next decade. Think long haul, don't think short term. That's what I would suggest.
All right, Kenny, what's some mistakes I can avoid from losing my shirt?
Yeah, so and actually I'm going to kind of break this up into 2 different buckets. The second one, Sachin, is basically just agreeing with you, so enjoy that. But we already talked about kind of the technical pieces, so I'll reiterate some of the points that I made here. Do test trades, just do test trade. Even if it's $100, put it in, put it out, transfer it around before you do anything significant, right? Because there are so many coins. It's so easy to mess up an address, or, you know, it's like I said, a lot of these DeFi solutions are just copy and paste. they sometimes look the exact same, right? But they might be completely fraudulent, or they change one letter in the URL, right? So just really test first is the most important thing. The other risks we talked about, right? The soft rug pull, the hard rug pull, just the hacks, read the audits, do the rug doc analysis, things like that. Just basic diligence before flinging money around. The second piece is, maybe we'll go super high level and talk about portfolio management. This is, Sachin, to your point, is a long haul. The way that pretty much every institutional investor on the planet allocates is they set percentages of their portfolio to be in a particular asset class. So the goal at the end of the day is buy low, sell high. So if you say, hey, I want to be 70% equities, 20% fixed income, and 10% crypto, right? That kind of makes sense at a macro level, right? You have some exposure to crypto, you get some of the upside. But the important thing is you have to keep those percentages. Because if crypto is going up and up and up, it is very much human nature to buy more, because it's just going to keep going up forever, right? That is not true. That's not how anything ever works. So by forcing a 10% allocation, say, of your portfolio to cryptocurrencies, when it goes up and it doubles, you're selling. You're selling the whole way up and taking the profits. And when it crashes, which it's crypto, so it's gonna, you're going to be buying back up at a lower price. So that is very much buy low, sell high. But you set those percentages up front, and you are disciplined about maintaining them. Don't keep smidging them one way or the other to try to protect it. And if you do that, then all of a sudden your portfolio makes a lot more sense. You have better risk in place, and you're not going to lose your whole shirt because you have more of a diversified approach to it. But don't just go long crypto and hope for the best.
So Bill, as an investor, what's your realistic threshold of pain that you can take in kind of involving yourself with this asset class?
Yeah, no, it's a great question, and it really depends on what kind of a bucket you want to put it into. So, for instance, if I'm looking towards something that's more venture oriented, something that perhaps like Sachin Fund is more aimed at, then yeah, I'm going to put that into a venture capital. So I'm willing to accept a high degree of volatility or potential loss of capital, more specifically, for the upside gain, which could be multiple X on that. Now, if I look at it from a fixed income substitute fashion, perhaps something that Kenny's offering, then it's a whole different thing. And I'm looking for a reasonable level of return, but at the same time, the emphasis is much more on on the risks. What sort of risks am I going to be taking? Specifically, what's going to be the risk of loss of capital, which is kind of strange to talk about as a fixed income substitute, because nobody even assumes that. But once again, it's like you really have to go back to basics, and you have to ask all the questions from the ground up again in order to make sure that you've got an allocation into a strategy that is consistent with your overall strategy and guidelines. And that way, your staff, your investment committee, your trustees, nobody will be surprised, because you've been able to manage the expectations properly, and you've been able to put it into the right bucket so that everybody understands, what to expect. And actually, if I could throw one question into the hopper,
Sure.
maybe you guys talked about before I was able to come on, but I think the investors and allocators out there might be interested to kind of understand sort of the range of return, I think, couched in the sense of capacity. So obviously, as Kennedy alluded a little while ago, you can get some ridiculous returns out there, but they're extremely fleeting. So, guys, can you comment just a little bit in terms of what the range of returns might be, but at the same time also comment in terms of, like, is this something that maybe is going to accept, a couple of million, 10 million, 100 million, or are we talking, like billions of worthwhile opportunity, if I may?
Yeah, sure.
Me or you? Yeah. Okay.
Go for it.
Yeah, I can hear from you. Well.
Yeah. So it's a hard one. So, and that is exactly the way to look at it, right? If your target is a 5 to 10% yield, by going to more conservative or more established, not conservative, more established platforms. That's in the billions. It just is. Uniswap, Convex. There's so many solutions out there that you can do this. BlockFi to Sachin's about, there's CeFi solutions as well that you can get that type of thing. There's a lot of capacity in that. As that bumps up, it gets harder and harder. We're kind of hovering in between the 30 and 50 at the moment % in the stable FI fund, which is that market neutral strategy. For there to kind of, if we put that 30 as the bogey, I mean, in the current market, that strategy probably has room for 30 to 40 million, something along those lines, because these are so brand new. And these crazy, if you've got $1,000 to invest, like, you can get a lot higher returns than that, right? Like, to your point, when these new pools come on, it's like, I'm going to launch, I've got $20,000 under management, but you're going to get thousands of % return. Well, great. Yeah. If you have a small amount to put in, you can go in there and you can get that return. So it is, it definitely goes up from there.
Yeah, I'd echo all that Kenny just mentioned. I think my sense of it is that the yield is hovering between 5 and 10%, depending on what platform you're on, what you're operating with. And for me, I do believe in the future there's going to be fee compression and interest compression because of competition, because of commoditization of some of these services. So I'm expecting, for everything from like a Coinbase transaction, which is on the higher end of a transaction right now, fee compression there, all the way to interest compression in the DeFi world to potentially occur. And so I would expect that. So I don't know how sustainable the current climate is. That's why there's actually probably interest to get involved sooner than later and DeFi, because I do think we are in a Goldilocks zone of great activity. But yeah, and I don't know when that's going to occur, that fee compression. I think my suspicion is that is going to occur right after the next halving. Right after, I'm expecting a huge balloon of activity to occur up until the next halving. So around, let's call it 2025, a consolidation and perhaps a fee compression that may occur around that time.
So you're saying you think this kind of Goldilocks gold rush is going to be with us for the next couple of years?
I think so, and I want to be very clear. I'm not saying it's going to go away. I just think that the good times can't last forever, right? So some of these high interest bearing things, and some of these they will still be good, and they'll be they'll still be much better than the traditional financial world. Okay, but I just don't. It is hard for me to believe that we're going to be operating with a 7% interest on some of our crypto forever. It's a hard thing to do, especially when you have competition, commoditization. People are going to have to differentiate on price, and there's going to be a race down to the bottom on price and interest, so, or other things. So that's how I kind of view it.
Kenny, what are your thoughts on how long the good times will keep rolling?
That man, my crystal ball just never seems to work the way I want it to,
right.
Unfortunately.
Right.
So I tend to view it more on chains as we come on. So each time there's a new chain that is able to do DeFi, not all of them can. You see this proliferation of these pools and a lot of the dynamics we've talked about, where it's like small brand new pools, and then once the chain becomes more established, you start to see less of that. Like Binance Smart Chain is an example that was very hot maybe 6 months ago. We're not doing anything on there anymore right now because the yields did compress. So looking then out at the roadmap of chains that are coming online with DeFi in a major way, I can see Cardano has promised DeFi for a long time. Polkadot similarly has high hopes of being a cross-chain DeFi solution. And then Solana, you're seeing Phantom. So these are just now really kind of getting into that space. So by the time they get up and you see this whole cycle go through of all these pools for a new chain, that's going to take us out at least a year or two. And then from there, it really is what's more on the horizon. Or is it going to be more chains and new value props? Is it going to be a lot of Me Too chains that nobody really cares about? I'm not entirely sure. So I would guess 2 years.
All right. So how about we do a final thought? So let's do a round for everybody. Bill, we never start with you, so I'm going to start with you. What are your final thoughts or contributions or even questions you want to add?
Sure. No, I'll just put in a plug. You know, even though it appears a little scary out there, I think this space is too big, and the asymmetry that's associated with it is too large to ignore. And even if you're an investor of size, it warrants taking a hard look at it. I think that the prudent thing is to get comfortable with and the guys have just really had great comments along that line, but you need to be able to size it appropriately and make sure that it's in the right bucket. But it's definitely something that people should not ignore and need to get into it, at least on a research basis right away.
Did you have contact information that you wanted to provide for anybody or anything like that?
Sure. Yeah. If people would like to get in touch, my email is very straightforward. It's bill.deichler, which is DEUCHLER at CNL.com.
Awesome. All righty. Sachin, you're up. Final thoughts.
Right. Yeah. So there really is, I think, a great dislocation, as Bill was mentioning, between traditional finance and the world of DeFi, and the ripple effect that DeFi is going to offer in the world of finance is real. It's happening. The value creation is being made right now. And I think there's going to be, over the next decade, there's going to be a lot of value creation that has been made. And I think we're probably in the first or second inning. Some of my partners actually believe the Star Spangled Banner is just being finished, and we're just like, that's how early we are, right? So the point is that we are early still. So I would definitely encourage people not to dive in, but to figure out what their position is, figure out who they want to partner with, what protocol or what platform, or how they want to engage. And I'm happy to kind of answer any questions or engage after this. And although I'm not super active on Twitter, I'm increasingly getting more active. So if you want to reach me there, at @sjaitley is where you'll find me. And if you DM me, I'll be sure to respond on there.
Awesome. Kenny?
Yeah, so one thing that might be interesting to the crowd is I actually was for a very long time a crypto bear. In that I probably started watching around 2012 and just never really saw a use case that made a lot of sense. There was the technology, and it just, especially during the heyday of 2018, give or take, you saw all these companies that, first and foremost, they were blockchain. Blockchain is that's not a business strategy. Right? Your technology is not a business strategy. That's not how that works. You actually need to have a problem that you're solving. And then once you find the problem, you need to choose the best technology. And if it happens to be the case that now there's a problem that can only be solved by a new technology, like, that's really cool. DeFi was the first time I saw it, where you have now so much revenue up for grabs and market share that if you grab from more traditional financial institutions, if we can do it in a more efficient, decentralized manner, unbelievable amount of opportunity. I would go so far as to say that DeFi specifically, digital assets more generally, presents the largest, potentially most lucrative investment opportunity that we will see in our generation. But yeah, so as far as contact information, it's right there, diffusefunds.com. If you've got a QR code, thank Isla for that one, because she does everything around here. And you can also email us, contact@diffusefunds.com.
Well, thank you, everybody. This was a great panel. We really appreciate it. Really appreciate your time. Thank you, gentlemen. And thank you, everyone. Be tuned. We will be doing another one of these at the end of the year. Date to be coming soon. Also, check out our site. You can see our upcoming events. Make sure you register. We got some good stuff coming up next week. Thank you again. And this will end the broadcast. Everybody have a great day and great weekend.
Thank
Bye-bye.
you.
Thank you.